Good day. My name is Ridwan Khan, and I'm the tax director at Turning Point Chartered Accountants SA. I've been a tax director at Turning Point for the last 15 years, and I assist NPOs with a number of tax compliance issues ranging from income tax to value-added tax and a whole host of different taxes that will affect your NPO. Today, I want to talk to you about value-added tax. Many NPOs are unaware that separate VAT registration rules exist for them. They incorrectly apply corporate VAT rules when determining whether to register for VAT or not. Corporate VAT rules are generally something different. They're based on whether an entity is making the required amount of revenue in a period. This revenue generally called taxable supplies, and if they meet certain thresholds, they could register for VAT. The VAT Act recognizes that NPOs don't generally make taxable supplies, as their income is mainly from donations. They therefore generally do not qualify for VAT registration when applying this income rule, which is applicable to corporates. Consequently, the VAT Act applies what we call an activities-based rule to determine whether an NPO may qualify for VAT registration or not. So even if your NPO has no other income other than donations, it may qualify for VAT registration, even if it does not make the specific income, but it carries on specific activities. These activities are generally called welfare activities in terms of the VAT Act. And if an NPO registers for VAT, there are huge benefits that may flow to an organization. As mentioned, the rules for VAT registration are based on activities that the NPO carries out. And if an NPO is registered for VAT, it can claim back all the input VAT. An input VAT is a VAT that's charged by suppliers to the NPO when they're purchasing goods and services from them. All of this VAT can be claimed back if the NPO is incurring those VAT in the carrying out of welfare activities. So if one has to look at the various costs that's generally incurred, these would include direct costs in carrying out the welfare activity. For example, if your NPO was feeding poor people, then you would have various costs, could be direct costs like food preparation costs and distribution costs, and the VAT incurred on these would be fully claimable by your NPO. Then there would be other indirect costs like your rentals, electricity, telephone, and if these are incurred in the furtherance of that activity, input VAT may be claimed back. Further, there may be a number of other costs like capex costs, which is furniture, equipment, land and building, and even motor vehicles, whereby input VAT can be claimed. So therefore, it's important that one really determines whether your NPO qualifies in terms of the activities for VAT registration and not by the revenue that it generates in terms of taxable supplies. When registering for VAT, an NPO has to take due consideration and determine whether any of its income streams may attract output VAT. What is output VAT? It's the VAT that an NPO has to charge its customers for any goods or services that it supplies. Typically, an NPO only receives donation income, will generally not have output VAT, as donations received from donors do not generally attract output VAT. However, when NPO sells goods or services, it will generally have to charge VAT and pay these over to SARS. In such cases, the corporate rules and the NPO rules are very similar. One of the most common mistakes that we see happening is the treatment of grant or donation income. Many NPOs do not properly scrutinize these donation agreements to determine whether these are really true donations. What's a true donation? Something that's given purely gratuitously, meaning that the grantor is not expecting any reciprocal benefit, any quid pro quo. In terms of the VAT Act, the wording is actually a direct identifiable benefit back from the NPO for that donation made. So in such cases, it may not be a grant, but in actual fact, it may be a service level agreement just packaged as a donation agreement. So what's quite important is for the NPO at the inception of the grant agreement to go through the finer details to determine whether there's some kind of acknowledgement that's required back from the donor. In a lot of cases, you may find this acknowledgement in the terms of some kind of advertising required back from the NPO for the donation made by the grantor. So therefore, one has to look at it to see, is it just a mere acknowledgement or is it something more? And does a direct identifiable benefit then flow back to the grantor for that donation made? If treated incorrectly, there could be serious VAT consequences, as output VAT could be payable on these amounts received if it's not a true donation. And if the NPO then fails to declare them, it could possibly lead to interest and penalties be levied by SARS. As mentioned earlier, VAT on expenses which are incurred in the furtherance of an NPO's welfare activity can qualify to be claimed back. An NPO needs to ensure that its financial processing is not only up to date, but its finance staff are also aware of the VAT rules when capturing these transactions, and incorrect processing or simple processing errors could lead to a loss of money. Across a number of NPOs which incorrectly apply the VAT corporate rule when determining whether to claim back input VAT. They incorrectly look at the source of funding to determine whether VAT can be claimed back. And in these instances, their general process is that if an expense was funded by donation income, then one cannot claim back the VAT. From an NPO point of view, it's an activity-based rule, and therefore one would have to look at whether the expense was actually incurred in the furtherance of that activity or not, and not whether or how it was funded, whether it was funded by revenue or by donations. An incorrect output or incorrect result, incorrect processing of these transactions applying corporate rules could lead to serious financial loss to an NPO. Lastly, I'd like to mention that being registered for VAT is a huge benefit for your NPO if you do qualify in terms of the activities that you perform. And you should register to ensure that you claim back these benefits and unlock real cash back into your organizations. Saying this, being registered for VAT does come with many obligations, and NPOs must be aware of these obligations to remain compliant, as SARS will not hesitate to levy interest and penalty for any non-compliances. Here at Turning Point Chartered Accountants SA, we've been advising NPOs on VAT for the last 15 years. We're not only assisting them in maximizing their cash flows, but also in remaining compliant with SARS in terms of the obligations and duties. We've developed a number of tools to assess whether an NPO is maximizing VAT claims and managing their VAT obligations at the same time. One example of this is our internally developed NPO Needs Analysis. It's free of charge and can be accessed via our website. It's a simple, easy-to-use checklist of questions which allow our teams of experts to analyze, amongst other things, the status of the VAT compliancy in your NPO. I therefore request you to visit www.tpcsa.co.za, access the needs analysis, and let one of our team members be in contact with you to see how we can assist you in your VAT obligations.